Ladies and gentlemen, today I want to talk about something that every trader faces, yet so many overlook. It's not your strategy, it's not your indicators, and it's not even your plan. It's a single moment in time. The time you decide to enter a trade, from 90:15 to 90:30 in the morning, markets come alive. There's volatility, there's movement, there's opportunity, but there's also danger. The difference between a winning trade and a losing trade often boils down to that 15-minute window. It's in that time frame that your preparation, your discipline, and your psychology all come together, or fall apart. Most traders think the market owes them success. They think that if they have the right chart, the right setup, and the right news, the trade will just work. But here's the truth: the market doesn't care about you. It only reacts to price, to volume, to momentum. What matters is your ability to act in the moment with clarity, without fear, without hesitation. That 15-minute window is more than a time on the clock. It's a test of your mind. Can you wait for the signal? Can you trust your plan? Can you accept the risk without trying to control the outcome? This is where most traders fail, not because they don't know what to do, but because they can't control their mind at the critical moment. Think about it: the market opens, and suddenly everything feels urgent. You see a move and your instincts scream, "Go now." But if you react out of fear or greed, you'll almost always be wrong. The right time to trade is never a guess. It's a choice based on preparation, observation, and emotional control. Preparation means knowing your setup, knowing your entry, your exit, your risk, and your reward. Observation means understanding the market context, the patterns, the behavior of other traders. Emotional control means staying detached from the outcome, staying grounded in reality, and acting decisively when your rules are met. And here's the key: timing is never about predicting the future. Timing is about responding to the present with precision. It's about seeing what the market is actually giving you, not what you hope it will give you. 90:15 to 90:30 a.m. is a metaphor for any moment in trading where you must act. It's the crucible that separates disciplined traders from impulsive ones. So the next time you're watching the clock, waiting for the right trade, remember this: it's not the market that decides your success, it's you. The time is only a number. The decision, the clarity, and the discipline are everything. If you can master that, if you can act in that small window with confidence and control, then the results, your results, will take care of themselves. Remember, the market doesn't reward luck. It rewards preparation, patience, and the courage to act at the right time. That's why the only time that truly matters is the time you decide to trade, and the way you decide to trade it. Let's begin at the heart of trading, the moment that defines success or failure. Many traders believe that their strategy, their indicators, their charts, or even their financial news feeds are the keys to winning. They think if they just follow the right plan, the trade will automatically work. But the truth is far simpler and far more difficult. The key isn't the strategy, it's the timing. Timing decides everything. From 9:15 to 9:30 in the morning, the market behaves in a way that exposes both opportunity and weakness. Prices move with urgency, volume spikes, and trends that seem invisible before suddenly become obvious. Yet, in these 15 minutes, most traders fail. Why? Because they misunderstand the role of timing. They confuse activity with opportunity and activity with decision making. Think about a trader you know, or perhaps yourself. You watch the charts, the price is moving up and down, and instinct screams, "No is the time to act." You jump in, your heart races, and almost immediately the market turns against you. Or maybe you hesitate, waiting for the perfect confirmation, and by the time you commit, the move is over, the profits evaporated, and you're left with frustration. Both outcomes stem from the same root cause: mismanagement of timing. Timing is not about luck. It's not about predicting what will happen. It is about observing reality as it unfolds and responding decisively. 15:9:30 window is a metaphor for any moment in trading where a decision must be made. The market opens, new information floods in, and you are confronted with a choice. Do you act? Do you wait? Do you force the trade? Or do you let it come to you? Let's take an example. Imagine you are trading a momentum breakout in a popular stock or currency pair. Your preparation is thorough, you've studied the historical patterns, you've analyzed volume, and you've defined your risk precisely. At 90:17, the price breaks through a key resistance level. Instinctively, you feel the surge of opportunity. The temptation is to enter immediately, fearing that hesitation will cost you the move. Yet a disciplined approach requires more than instinct. You observe: is the breakout supported by volume? Are other indicators confirming momentum? Is the broader market context aligned? If yes, you act. If not, you wait. Timing demands patience as much as it demands action. Most traders, however, act emotionally. They are either early or late. The early trader acts out of fear of missing out. The late trader hesitates because of fear of loss. Both fail to master the most critical element: responding to the present moment, not to imagined outcomes. This is where preparation intersects with psychology. Preparation is the foundation of timing. You cannot hope to act decisively if you haven't defined your rules, your limits, and your objectives in advance. Preparation is not just technical, it is psychological. It is knowing your own tendencies, your triggers, and the way your mind reacts under stress. A trader who is unaware of their emotional patterns is at the mercy of the market. A trader who knows themselves and follows a disciplined plan is in control, even in the chaos of the market's opening minutes. Here's a practical exercise. Before you trade, visualize the 9:15, 90:30 window in your mind. Picture the price movement, the volume surge, the market noise. Now imagine yourself following your plan, observing, waiting for confirmation, entering at the precise moment, and exiting according to your rules. Repeat this visualization daily. By doing so, You train your mind to respond with clarity and confidence when the real moment arrives. Timing is not just mechanical, it is mental. Another aspect of timing is flexibility. The market is not predictable. You cannot control every outcome. What you can control is your entry and exit decisions, the way you interpret the signals, and the discipline you apply in real time. Timing requires the ability to adapt to changing conditions without abandoning your rules. It is the balance between structure and responsiveness. Let's consider another example, this time from the currency markets. A trader prepares for the opening of the Forex session, analyzing economic news releases, central bank announcements, and historical volatility patterns. At exactly 90:20, the market reacts to unexpected news and the price begins to spike. The trader's preparation allows them to recognize a valid setup immediately. Their psychological readiness allows them to enter confidently, without hesitation. In those critical minutes, the difference between profit and loss is determined entirely by the timing of the decision. Timing also involves accepting uncertainty. Many traders hesitate because they want absolute confirmation, but the market will never provide certainty. It only provides probabilities. The disciplined trader understands this and acts within the framework of calculated risk. The question is never whether the market will go up or down. The question is whether the setup aligns with your rules and whether the timing is right to act on it. This brings us back to the essence of trading psychology. The market is neutral. It does not reward effort, intelligence, or hope. It rewards decisive action based on clear observation, preparation, and discipline. The time of the trade, when you enter and when you exit, is the ultimate determinant of success. As we continue through this seminar, remember this principle: your strategy is only as good as your ability to execute it at the right time. Your indicators are only as useful as your mental clarity allows you to interpret them in real time. Your preparation is only as effective as your discipline permits you to act decisively. Timing is the bridge between preparation and outcome. Without it, even the best plan fails. As we move forward, I want you to understand something fundamental. Trading is not just about chart strategies or technical setups. The most important factor that determines your success or your failure is your mind. More precisely, it's the state of your mind in the moment you decide to trade. From the opening bell to the first movement of price, your mind is under pressure. Fear whispers, greed shouts, doubt creeps in. Every trader experiences it. The difference between a successful trader and one who constantly loses isn't skill or luck. It's the ability to master your mind at the critical moment. Let's examine fear first. Fear is subtle, but it is deadly. Fear of loss can make a trader hesitate, missing the ideal entry. Fear of missing out can make a trader jump into a trade prematurely. Both are the same emotion with different disguises. At 90:15 to 90:30, the market is alive with volatility. Fear will try to dictate your actions. A novice trader might react immediately to every spike, thinking the market is sending signals. But these are not signals, they are tests. The market tests your preparation, your discipline, and your psychological readiness. Here's an example. Imagine a trader monitoring a breakout in a currency pair. The price pushes through resistance with strong momentum. Instantly, the mind reacts, act now, don't miss it. Fear of missing the opportunity is overwhelming. A trader who has not trained their mind might enter without proper confirmation, only to see the market reverse shortly after. In contrast, a trader who has mastered their mind observes calmly, waits for confirmation, and enters when the setup aligns with their rules. The difference is psychological mastery. Timing alone is insufficient without control over your reactions. Now, let's talk about greed. Greed disguises itself as ambition or confidence. It says, you can push further, you can make more. Greed tempts traders to over-leverage, to hold positions too long, or to chase moves that are no longer favorable. During the opening minutes of a session, greed is particularly dangerous because volatility can exaggerate gains and losses. Mastering greed requires awareness, recognizing it, acknowledging it, and refusing to act impulsively. A powerful exercise for mastering the mind is pre-trade visualization. Before the market opens, close your eyes and imagine the trades you are likely to encounter. See the price moving in real time. Feel the surge of fear and the pull of greed. Now, rehearse your response, observe, analyze, and act according to your rules. By practicing this mental rehearsal, you train your mind to respond calmly under pressure. The goal is not to eliminate emotions, they cannot be eliminated, but to manage them effectively so that they don't control your decisions. Another critical element of mental mastery is detachment from outcome. Most traders measure their self-worth by the result of a trade. This is a dangerous mindset because the market is neutral. It doesn't care about your plan, your preparation, or your intentions. Attaching your identity to the outcome creates emotional turbulence that clouds judgment. Successful traders act according to a plan, accept the risk, and let the result take care of itself. Emotional detachment does not mean indifference, it means clarity and discipline in the face of uncertainty. Let's consider another example. A trader notices a rapid move in a stock during the first 15 minutes after the opening bell. Their instinct is to jump in immediately, but their preparation requires waiting for a specific signal, a confirmation of momentum supported by volume. As they watch, their mind generates fear and doubt. Maybe I'm too late. Maybe I missed it. If the trader succumbs to fear, they act impulsively and likely enter at a suboptimal point. If they master their mind, they wait for the exact moment dictated by their rules, entering calmly and confidently. That control of thought, of emotion, of impulse, is what separates consistent winners from chronic losers. Mental mastery also involves recognizing patterns of self-sabotage. Some traders consistently exit too early, denying themselves profits, while others exit too late, letting losses accumulate. These patterns are not caused by market conditions, they are caused by your own mind. Awareness is the first step. Ask yourself, what patterns do I repeat? Where do I let fear or greed dictate my actions? Only when you understand your tendencies can you consciously choose to override them. Mind mastery is also about accepting uncertainty. The market never guarantees success. Every trade is probabilistic. Accepting this truth allows you to act decisively without needing certainty. Traders who seek certainty will never act. They wait endlessly for the perfect setup that will never arrive. Traders who embrace uncertainty can enter trades with confidence because they understand that the risk is managed and the outcome is irrelevant to the quality of the decision. Here's another practical exercise for mental mastery after each trading session. Review your trades not by profit or loss, but by mental execution. Ask yourself, did I act according to my plan? Did I control fear and greed? Did I wait for confirmation, or did I act impulsively? By reviewing your mental performance, you develop awareness and improve your future responses. This is the essence of psychological growth in trading. It's not the market that changes you, it's how you manage your mind in response to the market. Finally, remember this principle: the moment you decide to trade is a test of your mind. You can have all the technical knowledge, all the strategies, and all the indicators in the world, but if you cannot act with discipline, clarity, and calm, you will fail. Mastering your mind is not a one-time effort, it is a daily practice. It requires honesty, self-awareness, and relentless discipline. The rewards are immense: discipline, clarity under pressure, confidence in decision-making, and the ability to act decisively when opportunity appears. Preparation is the foundation of every successful trade. Timing, skill, and psychology matter, but without preparation, they are useless. Traders often underestimate this. They focus on strategies or indicators while ignoring the work required before the market opens. Preparation is not just about charts or numbers, it's about mental clarity, defined rules, and disciplined execution. Every moment in trading begins long before the trade itself. The trader who prepares in advance enters the market with confidence, knowing exactly what to do and when to do it. The trader who fails to prepare reacts emotionally, chasing price, second-guessing signals, and often losing before the trade even begins. Consider a trader approaching the opening of the session. Their preparation begins the night before. They review market trends, economic news, support and resistance levels, and volatility expectations. They write down potential setups, entry points, stop, loss levels, and targets. They mentally rehearse scenarios. What if the market spikes up immediately? What if it gaps down? What if the signal doesn't fully confirm? By thinking through these possibilities, the trader primes their mind to act decisively when the moment arrives. Preparation also includes self-awareness. A trader must know their psychological tendencies: the instinct to overtrade, the fear of missing opportunities, the temptation to move stop losses prematurely. These tendencies, left unchecked, undermine even the best technical analysis. By acknowledging weaknesses, the trader can set rules to counteract them, such as strict risk limits or mandatory confirmation before entry. An example illustrates this well. Imagine a trader focusing on a momentum breakout in a currency pair. Their plan is clear: enter if the breakout is supported by volume, hold until the first resistance, and exit if momentum weakens. At the market open, the breakout occurs. Traders without preparation act impulsively. They enter immediately hoping for profit, only to see the move reverse. The prepared trader, however, waits for volume confirmation, enters at the optimal point, and manages the trade according to their plan. Preparation defines the outcome. Preparation also means creating a checklist. Before every session, review market context, technical patterns, economic news, entry rules, exit rules, and personal mindset. A checklist keeps the trader grounded. In high-stress moments, the mind tends to overcomplicate decisions. A clear written plan simplifies choices, reduces emotional interference, and increases the probability of successful execution. Preparation is not static, markets change. Each session requires fresh review. Yesterday's patterns may not repeat, new news can shift trends. A trader must adapt, not react. Preparation involves constant observation, analysis, and mental rehearsal. By staying engaged with the market before it opens, the trader builds the foundation to act decisively in real time. Another key aspect is defining risk clearly. Many traders enter trades without precise understanding of how much they are willing to lose. Preparation forces clarity: exact stop-loss levels, position sizes, and acceptable outcomes are determined in advance. This eliminates hesitation when the market moves. A prepared trader does not panic, they act according to the plan. Visualization exercises are an essential part of preparation. Before the market opens, imagine the trades you might take. Picture the price moving, the volume surging, and the signals confirming. Imagine acting calmly and precisely, executing the trade according to your rules. By rehearsing mentally, you train your brain to respond automatically and correctly during real trading. Preparation also includes learning from past experiences. After each trade, review not only the outcome but the process. Did preparation guide the decision? Were rules followed? Were emotional reactions managed? Identify mistakes and adjust your approach. This iterative process is how preparation evolves into skill. Discipline is intertwined with preparation. A trader can prepare thoroughly, but without discipline, the plan will be abandoned in the heat of the moment. Preparation defines the moment, but discipline enforces it. Traders who lack discipline are like pilots without instruments. They see the horizon but cannot navigate accurately. Preparation provides the instruments, rules, and procedures. Discipline ensures they are followed. A practical example: a trader plans for a breakout at 10:00 a.m. Their entry is conditional on confirmation from 3 indicators: At 10:01, the price begins moving but only one indicator aligns. Without preparation and discipline, the trader might force an entry chasing profit. With preparation and discipline, the trader waits until all conditions are met, enters at the correct point, and manages risk properly. The difference is measurable. One scenario likely results in a loss, the other in a controlled, profitable trade. Preparation also builds confidence. Confidence is not born from emotion, it is born from structured readiness. A prepared trader doesn't second-guess themselves in volatile markets. They know what to do, why they are doing it, and how to handle any outcome. Confidence allows the trader to act decisively rather than hesitating, which is critical during moments when the market moves rapidly. Finally, preparation extends beyond technical skills. Mental and physical readiness are essential. Traders who are distracted, fatigued, or stressed cannot execute effectively. Preparation includes sleep, nutrition, and mental focus exercises. By treating trading as a discipline requiring holistic readiness, the trader ensures that their decisions in the critical moment are guided by clarity rather than fatigue or stress. Preparation defines the moment, but it is not preparation alone that creates success. It is preparation combined with action, discipline, and psychological awareness. Traders who fail often have plans but lack the mental readiness to follow them. Traders who succeed have prepared comprehensively, rehearsed their responses, and conditioned their minds to act decisively. Everything you have learned, every preparation, every mental exercise, every strategy comes down to one thing: the moment you act. Traders often study, rehearse, and analyze for months or even years, but success is ultimately determined by the decision to enter or exit a trade at the right time. The market does not reward knowledge alone. It does not reward preparation alone, it rewards execution at the right moment. The time you act is when all probability transforms into reality. You can have perfect analysis, clear rules, and strong discipline, but if you fail to act, the opportunity passes. The difference between a profitable trade and a loss is often measured in seconds. That is why every trader must understand the importance of the critical moment, the instant when observation, preparation, and psychological readiness converge. Consider a scenario in the stock market. You've prepared all week, identified a breakout pattern, and set your rules. Enter on confirmation of the breakout with supportive volume, exit if momentum weakens, and always respect your stop loss. The price begins moving at the open, indicators align, volume surges, the setup is perfect, you hesitate, seconds pass, the market moves, and the ideal entry disappears. That moment, the decision to act, is where most traders fail. Execution is everything. The challenge is psychological. Fear, doubt, and overthinking interfere. Traders often wait for certainty that will never come. The market is probabilistic, not deterministic. Acting decisively does not guarantee profit, but not acting guarantees missed opportunity. Mastering execution requires not only preparation but also trust in your analysis, your rules, and yourself. Here is a practical method for mastering action. Define your entry, your exit, and your risk in advance. Then practice executing trades according to those rules without hesitation. Use historical charts to rehearse. Watch past price movements and practice identifying the exact moment to act. This develops both timing and confidence. By training your mind and hands together, action becomes almost automatic under pressure. Execution also requires emotional detachment. The market will not move according to your hopes. It will not reward your impatience or punish your caution unfairly. It will simply move. Traders who are emotionally attached to outcomes hesitate or overreact. Those who can act according to the plan, regardless of fear or desire, are the ones who consistently succeed. Consider the Forex market. A trader observes the EUR-USD pair after an economic announcement. Price spikes dramatically. The trader's rules dictate entry if momentum continues for 2 consecutive candles and volume supports the move. The market is volatile, emotions are high, and the temptation to jump in immediately is strong. The disciplined trader waits, observes, and enters exactly at the moment dictated by the rules. The undisciplined trader either jumps early or hesitates, missing the move entirely. Once again, action at the correct moment makes all the difference. Timing your action also means understanding when not to act. Traders often feel compelled to trade, believing inactivity is wasted time. Yet, the most important action is often restraint. Waiting for confirmation, staying out of the market when signals are weak, and avoiding impulsive decisions are all forms of action. Deciding not to act is as critical as deciding to enter. Execution is about responding to reality, not forcing outcomes. Another key factor in action is risk management. You can act decisively, but without defining risk clearly, decisive action can become reckless action. Position sizing, stop loss levels, and maximum loss per trade must be determined before entering. Acting without these safeguards transforms a disciplined decision into a gamble. By integrating risk management into your execution plan, you ensure that each decision, whether it results in profit or loss, supports long-term success. A powerful exercise for mastering execution is the post-trade review focused on decisions, not outcomes. After every session, ask yourself, did I act according to my plan? Did I hesitate unnecessarily? Did I force a trade? Did I follow my rules? Over time, this review trains your mind to recognize the correct moment and act without emotional interference. The quality of your decisions, not the result of individual trades, determines long-term success. Speed and clarity are also critical. In fast-moving markets, hesitation can destroy profitability. Acting decisively requires that you have prepared for multiple scenarios. Know your trigger points, your signals, and your confirmation criteria in advance. When the moment arrives, you do not analyze endlessly, you act. Hesitation at the critical moment is one of the leading causes of trading failure. Consider an example from day trading. A stock begins a rapid upward movement immediately after the open. Traders who are prepared and disciplined recognize the breakout pattern and enter quickly. Traders who hesitate because they are analyzing too many indicators or waiting for a perfect confirmation watch the move pass them by. The difference is not skill or intelligence, it is the ability to act at the precise moment. Execution also involves accepting imperfection. No trade is perfect. Even with preparation and discipline, losses occur. Acting decisively does not eliminate risk. What it does is ensure that each decision is aligned with probability and planning. Traders who fear imperfection hesitate, second-guess themselves, or avoid the trade entirely. Mastering action means embracing uncertainty, executing according to the plan, and learning from every outcome. In addition to psychological mastery, execution requires mechanical readiness. Know your platform, your order types, and your execution speed. Technical delays, slow order entry, or misunderstanding of platforms can turn a well-timed decision to a missed opportunity. Preparation and mental clarity are wasted if execution is hindered by avoidable technical errors. Another exercise is to simulate real-time market conditions. Practice identifying the entry and exit points in fast-moving charts, setting orders, and executing trades within seconds. Training your reflexes combined with mental rehearsal ensures that when the market moves, your action is swift and accurate. Decisive action becomes second nature through repetition and preparation. Finally, the ultimate lesson of this keynote is simple: the moment you act defines your trade. Knowledge, preparation, and mindset are all essential, but without execution, they are meaningless. The market rewards those who can translate preparation into action at the right time. Acting decisively with clarity and discipline is the difference between consistent profitability and repeated failure. Every trade is a test of timing, mental control, and preparedness. The markets will continue to move, opportunities will continue to appear, but only those who can act in the right moment without hesitation will succeed. Execution is the bridge between analysis and results. Without it, potential remains unrealized, no matter how much preparation you have done. Mastery is not in knowing the market, it is in knowing when and how to act. The difference between winning and losing is measured in the split second you decide to press the button to enter or to exit. Train your mind, rehearse your actions, define your rules, and act decisively. The market does not wait, and neither should you. The moment you act is the moment your trade is made, and it is that moment that ultimately decides your success.